Welcome everyone. Thanks for joining us this morning on another Golf Australia webinar. This time on insurance, the challenges of the current market and what it means for golf clubs. First up, thank you all for joining us today, and thanks to our guests for coming on board. If I can just quickly introduce everyone. Maurice Gatto, Chief Commercial Officer at Marsh Pacific. Maurice, welcome. Thanks for coming along today.
Thank you, Matt.
Daniel Bateup, our Managing Director from Golf Business Australia, is his insurance broker. G'day, Daniel. How are you?
Hey guys. Good. Thanks, Matt. Thanks.
Where are you based, mate? Mainly East Coast, New South Wales?
Yeah, I'm up at Sydney, so you'll find me on the northern beaches of sunny Sydney.
Fantastic, mate. Thanks for coming along. And Peter McCarthy from Edgewise Insurance Brokers, Executive Director. Welcome, Pete. Thanks for joining us this morning.
Thank you, Matt.
Wonderful. So just to give the participants an idea about how today's going to work, we're just going to ask Maurice to give us a bit of a market overview about where insurance is headed globally and locally here in Australia, and just to cover off some of the challenges that the whole market is seeing. And then we'll throw to Pete and Daniel to give us a bit of an update about where the golf specific market's heading, after Maurice has touched on what's happening in the market in general. As always, more than welcome to ask some questions as we move through the webinar today by either using the chat function down the bottom of the screen or the Q&A function there as well. Don't hesitate to type in your questions at any stage, and when we get to the appropriate moment, I'll pipe up and ask them of our guests. So without any further ado, Maurice, I'll hand over to you to give us a bit of a market update and where we are in this challenging environment at the moment.
Yeah, thank you, Matt, and thank you all for taking the time to join us on this presentation. So from the broad perspective that I'll be looking at covering for you is trying to give you a bit of an insight as to as Matt said, the global market and local market conditions, and the relevance into golf, with then Daniel and Peter picking up on some specific things that golf clubs can do. But from my perspective, I'll look at the global trends, then we'll jump into the Pacific, which is really Australia, New Zealand and the islands. Then I'll give you some independent stats from APRA, who's the governing body, the regulator who takes on all the financial results of each of the insurers regulated to write business in Australia. Lloyd's update and the importance of that and the impact of that for all of you, and then some of the market drivers and sentiment that we're seeing and what impact that'll have for each and every one of you and also others in the broader economy and Australian businesses. So this data, just the first few slides, is specific to Marsh. Marsh are one of the largest global brokers. We have a lot of insight available in terms of trades across all classes of insurance: property, liability, motor, everything, financial lines that you can think of. These consolidated stats that we'll see over the next period show the quarters from 2016 through to the end of June of this year. And as you can see, for most of you who know how to read bar charts, you would have experienced over the last few years and even prior to 2016, what we call a very aggressive and competitive market. Basically a market that's littered with an abundance of capital, a lot of aggression in growth phase from insurers, and some positive results that predated 2016. So all in all, what that basically means is we had an environment where a number of insurers were competing aggressively for business. And then what we see is that trend movement from the far left of the screen to the far right of the screen as losses and global events start to impact insurer results and returns. We're seeing an aggressive turn in the pricing cycle. So on a combined consolidated global average, as you can see from 16, we were in quite a competitive, depressed pricing environment through to an aggressive move in Q2 of 2020. The pricing movement on average is notching up to about 20-odd%, 19% there. When I break down those by class specific and the relevance to you, from a property perspective, on average in the last few quarters, we've seen some aggressive pricing movement, double-digit figures. As you can see on the left-hand side, that relates to consolidated global property. Moving into the last quarter where we saw on average, as I said, just under 20% increases. The liability is the part that sits in the middle. By nature, liability being a long tail class of insurance, which means that the development and loss ratios coming through take a little bit of time to develop, and ultimately the pricing correction isn't as aggressive as property, which is normally hits and occurs in the period of insurance, as you'll be all well aware of. The global FinPro, just to get rid of the dialogue that is Marsh, that relates to directors and officers, management liability, crime, cyber type classes. And that's been one of the most aggressive moving prices that we're seeing for some time. And a lot of that comes from, in particular, the directors and officers loss ratio and the fact that that's such a small class of insurance. When I look at the region, so the particular regions and the returns, if you look at the US, we're starting to see significant pricing movement. In the UK, very similar trends to Australia. Continental Europe is going through pricing movement. As you can see, every region, including our own in the Pacific, has experienced price movement. So you would see through your own renewals and your brokers that you engage with that they've been talking about the market moving to a very aggressive pricing phase. From our perspective, and whilst it's hard for everybody on this call, and in particular golf, where if you're in Victoria like Macca and I and others, the shutdown of golf courses, the shutdown of businesses, it's very hard to get our mind out of, the COVID situation. But if you just draw your mind back to the start of this year, which seems like an eternity, we started with some significant bushfires followed by hail and flood. And when you look at insurers and their typical response to catastrophic events like those, there's a finite ability for them to write profitable business as they need to underwrite for, other losses like just fires and accidental damage and things like that occur. But we've had a significant, what we call catastrophe type environment in the first quarter. So the reason why you look at our Pacific being so aggressive in comparison to other regions is a couple of things. One is smaller economy. The second part is, in particular, our region is littered with what we call catastrophe type perils. So if you're from the north, the cyclone west is cyclone exposed, as well as other regions, or most of our regions have an element of bushfire and flood. And if you go across to New Zealand, we bring in the perils of earthquake in particular. So for a relatively small region, we add what we call a significant footprint in outweighed catastrophic type perils. And we're seeing weather patterns change more regularly than what they have in the past, which has meant the market's reaction to pricing is become more and more aggressive. If I overlay that, the regional versus global trends, you can see that there's significant pricing movement whilst the trend is following. The Pacific region is significantly higher than the global based average based on what I mentioned earlier. So when we break it down for our region into those particular classes, you can see that property's heading towards, and we're about to release the next quarter of data. It's just a week away from us being able to release it. But on average, we're looking at property hitting well and truly close to that 30% pricing movement. So, certain clients might experience a 10, 15% price increase. Others may experience in certain segments and industries in excess of 100%. On a combined basis and average in the region, we're seeing now close to a 30% movement on standard property. Liability or casualty, as I referred to earlier, so public and products liability is notching up to 10%. And the financial lines on average is nearly up to 50%. That will go over 50% in this next quarter. But importantly, some of the notes, and as Matt said, he'll share the content of the presentation, which we're happy for everybody to have. You'll see some of the commentary on the right-hand side. As they are averages in the bar chart, it shows you that certain insureds are experiencing in excess of 100% increases. So it's a pretty interesting environment that we're currently faced with. So when I look at, that was everything that's Marsh data, global traded. If I look at the total independent data, this is based on all brokers and all regulated insurers placing business into the Australian market. Over the last period through to 2015, again, the simplicity of the bar chart, the 100% line, the yellow or mustard line that you see there is where the dollars, it's basically dollars in, dollars out. The blue bar chart represents property. Now, most of you, who know how to read this would in excess of 100% means that effectively the rate of return, or for the capital investors, the insurers, would suggest that it's not, a safe bet to put your money in property insurance in Australia, given the historical trends. Now, that's a consolidated picture of all regulated insurers. A number of our big name insurers that you'll be well aware of, the likes of a QBE or a Vera or a CGU, in cases have significantly higher percentages in loss ratio stemming from their property portfolios. The reason why we talk to this for this group and our other clients is it's important to realise that insurers can only make money from a couple of things. One is they take your premium in advance 365 days out when you do your renewal through your brokers. There's two ways they can make money. They'll either make it on an underwriting return, which is obviously taking in more premium than losses paid, or an investment. And as we all know, the global and local investment returns for secure investments, which is what insurers are typically only charged with putting their money into, so short-term interest, term deposits, or government bonds for longer-term investment, have all been relatively depressed in their return on investment. So what that means for us as an industry, and Daniel and Peter will talk you through this, is that aggressive pricing is the only way that they can return to profitability. The other bar charts in there show the liability, which is the orange side. Pretty scary. The first time in a long time, and I've known Peter for some time. I've been broking for 24 years. It's probably the first time that we've seen since September 11 the liability tail come above the 100% ratio, which means we've got a local and global environment that is aggressively pushing price. So the outlook over the next 12 to 18 months isn't that positive from a buyer perspective. The other bar chart there is motor, one of the easiest classes for insurers to repair or bring back to profitability. It's a maths exercise. It's basically premium in, premium out. There's not a lot of volatility or severity in motor, so therefore they can correct that ratio very quickly. So if I just go on to Lloyd's and the importance of it, a lot of you around this table would say, well, Lloyd's probably has no relevance to me because of our size, shape and scale of the way that we place our business. We tend to deal with local Indigenous carriers. Lloyd's is important to understand what's going on there because Lloyd's represents most of the insurer's own protection to their balance sheet through reinsurance. So as at May, and we're just waiting for some updated data through paid losses, we were seeing in excess of $4 billion of losses just coming out of the COVID-related incidents. And most of you on this call would sit there and say, well, my policy doesn't respond to it. In Australia, being a relatively mature environment, there has been a pretty firm stance around COVID or pandemic type related losses, which the industry doesn't have really the balance sheet to fund those type losses. So you'll hear from most of your brokers that there's probably little or no recourse under programs. But in the globe, just to have a look at it, a lot of those losses are stemming from what we call event cancellation. Very, very topical for golf at the moment, as Matt and the team put out this morning that the tournaments are being cancelled here. There is a policy available to sporting events like, the Olympics, Wimbledon, and major Grand Prix events that they've bought an event cancellation abandonment type policy. 30% of those losses come from that. 30% come from the property side. But more importantly, if you look at the right-hand side of the chart, where it's coming from is economies that have had the ability to write this type of cover in their portfolios. So larger economies being the US and the UK. We sit in the represented region of other, being Australia, Canada and Asia. So not many policies in this region tend to respond. Again, down to the individual policy structures that those of you that would need to go through that side of it. So again, just to wrap up why Lloyd's is important, all insurers that are regulated by an element of protection for their own balance sheet through what we call reinsurance, Lloyd's tends to represent a significant proportion of that reinsurance. So the impact of Lloyd's through increased pricing and reduction in what we call capacity, available capital for them to protect their balance sheets has diminished, and also tightening of cover. So you would hear from your brokers that there are restrictions in cover going forward. So just to wrap up, from my perspective, what does it ultimately mean? What's the market sentiment? What can you guys look to do? without a doubt, based on the stats that I've just gone through in the prior slides, rate increases are imperative. There's not too much movement around people turning around looking at things commercially like they did a few years ago. Head office just not within the insurers just does not allow those deals to be done anymore in a very commercial way, you know, basically writing unprofitable business because of legacy or relationship issues. Everything now stands on its merits. Reduced line sizes, that's basically the capital available to place insurance into the market has come off, which means lower amount of capacity in the market, reduces the element of competition, which then goes on to the next point in the bottom hand corner, right-hand corner of that graphic. Most insurers now realise there's no need to compete. That's not an anti-competitive statement. That's just a stabilising statement. It's saying that they can try and get a profitable return on the book of business that they have and understand. So they'll look to remediate pricing based on that side of it. And then there's no real pressure to grow from a new business perspective because most insurers are looking for profitable returns on their existing book and the book that they know. And the final thing that I will say, just from a market sentiment perspective, is the first time in a long time, and Daniel and Peter will attest to this, and even your own brokers, insurers are prepared to walk. There's no longer this requirement to be wedded to an industry or wedded to a particular insurer. If they can't make commercial sense of it and they don't feel like that they can make a form of economic return for their shareholders, they will look to walk away from that business and genuinely not threaten it. They will move. So the final comment about being prepared, again, Daniel and Peter will take you through this, is I'll leave you with this statement around if we can't get quality information to your brokers who you've chosen to take you through the journey of your renewal and your risk issues, it will get filled with price because most insurers, in the absence of information, will make a call that they are prepared to take a more conservative position on, which therefore means increased pricing. So there are a number of things that you guys could look to being prepared. It's not about leaving it to the last couple of weeks to get your insurance needs in there. I know it's not an exciting topic for all of you, but the more prepared you are, the better off you are, because we are down to a very finite market who are prepared to write golf clubs. The industry has shown that their ability to make money riding golf clubs because of weather perils is quite limited. So we're down to a couple of markets. So I'll hand back to Matt and then the broader team for some specific golf items. Matt,
yeah, thanks, Maurice. That was a pretty solid overview there, mate, and pretty high level. But I think we'll look to Daniel and Pete to sort of take us into what this means for golf clubs. But some key takeaways for me there. In summary, high payouts, poor investment returns, meaning poor profitability, which is going to push premiums in one direction, and that insurers are now looking for attractive customers to them who sort of take control of their own destiny a little and start to control some of their own risk. Is that a reasonably fair summry there?
Pretty much. You can get a job in broking, Matt.
Mate, I think I'm going to stick with golf personally. But so Daniel, how do we translate what Maurice was talking about there to golf clubs, and how can we then, as golf clubs and facilities, try to get some more positive outcomes from where the insurance market is at the moment?
Yeah, thanks guys. Thanks for joining us. We'll try to add as much value as we can to that market analysis by Maurice. Certainly involved, but what I take away from that and what's been touched on is the golf industry isn't alone in being affected by this hard market. We are obviously one industry worldwide in Australia that has developed a high risk profile, and what we want to do as brokers, Peter and I and others, is try to improve that risk profile that insurers have formed an opinion of, and increase, the likelihood of other insurers or insurers providing reasonable terms. But I think we do this certainly through the balance of risk transfer. So what I mean by that is, as customers of insurers, they're looking for risks that are making an effort to reduce their risk of having claims. So we're talking about risk maintenance, risk mitigation, utilisation. So basically, if we can, as an industry, get together and collectively adopt good risk practices, I think we can turn the tide on what is a hard market. It's not going to happen overnight, but I think the short-term pain will be our long-term gain if we can do this now. So, yeah, as Maurice said, what amplifies the golf industry's sort of difficulties at the moment is that there is only two markets. Most of you will probably be aware of them. There were as many as 7 in the past 14 years. So I think if that tells us anything, it's that insurers don't have a lot of faith in golf clubs.
So this is the challenge, isn't it, though, Daniel? You're there as a broker, effectively acting on behalf of a club, supporting a club, and you're looking to place the insurance into market, and there's just significantly less places to place that insurance at the moment.
Yeah, that's right. And we get a lot of frustration from decision makers at golf clubs to, we just want alternate quotes to what we have. Now, if they're with one of those 2 insurers, that leaves us with one option. And then, as brokers, we make decisions around what is in the club's best interest. Is it, to get an alternate quote with another company, or work with their existing insurer who may have experienced several claims in the last 5 years, and try to improve their risk profile so that insurer can afford to offer reduced premiums or, more favourable excesses. And look, we touched on cover. At this stage, I think the cover for golf clubs that is available with these 2 insurers is quite good. It makes me nervous that we are in a hard market and that we still continue to experience a lot of claims due to, Australian climate, bushfires, storms, because soon enough, certain covers, and I namely think of the course itself, where we experience a lot of storm losses. They might be covers that one day we don't have the availability of because we're not managing our clubs aren't managing that risk correctly by practical risk mitigation strategies, and we'll touch on those a little later, Peter and I. But I think, the best way to combat it is collectively come together, and as an industry, difficult for everyone to adopt what we're going to discuss today. But if we don't, like Maurice said, insurers will simply walk away from our industry and we'll be left with no options. So, Peter, I guess, have you got anything to add to that in your experiences?
Daniel, I'd probably move on to the role of the insurance broker in this. Historically, an insurance broker role with golf clubs was to place an agreed insurance program and assist with claim situations, hopefully leading to a fair and reasonable settlement outcome. The service was usually provided on a one-size-fits-all basis, and hopefully the golf club's current experience is very different to this. Whilst underwriters put their capital at risk in providing the policy protection, the appointed insurance broker should be adding the value gap services of implementing a risk transfer program around the club's governance and risk management framework. This starts with conducting a full risk analysis of the club's strategic objectives, their financial situation, and their operational procedures. But at the end of the day, the premium outcome is primarily driven by the club's own claims history and that of the golf club industry. So they're the vagaries of what's happening in the market at the moment.
Yeah, I think it's clubs big and small. We get a lot of questions. A lot of clubs call us that are volunteer run, and it's, the question always comes up, we are a small club, our premiums seem excessive, but we are all part of the same industry and the markets that are willing to insure golf clubs. And I think, smaller clubs will certainly pay smaller premiums, but they are still exposed to the same risk exposures as larger clubs in some cases. So that's important to remember as well.
Yeah, I think the challenge for us as brokers to the industry is to try, and we're working in increasing premiums, increasing excesses, and reducing cover. The golf clubs have only got X amount to spend, so we've got to help them that spend is being directed towards the exposures that a proper insurance program can provide them with the protection in the event of a claim.
Yeah, that's right. And that's exactly it, Peter. It's this business partner approach that we've touched on. It's up to brokers and their customer golf clubs to partner together and work towards a common goal. You know, as brokers, we have that relationship with underwriters, with insurers, and they, you know, at their request, they want to see more from their customers and us as brokers to paint the risks that they're insuring in a better light. And I think nowadays insurance brokers need to act as risk management facilitators. There's so many strategies that you can introduce to golf clubs to reduce that risk, and you know, we'll touch on those today, and let's hope that, you know, a number of our audience can investigate those with their brokers, and we might see a downward trend in premiums and battle this tough market.
So let's jump into that rabbit hole a little bit then, if you like, Daniel and Pete. If we're looking at if we've got a club that's a golf course, like it's pretty exposed, like what we're talking about here is golf specific insurance. Like we've got some risks that just don't exist in other businesses, don't we? Like we've got an 18, 27, 36 hole facility that is out in the elements, that we've invested good dollars into by with our turf, with irrigation systems, etc. So we've got big investments there, but they're largely exposed, and that's a fairly unique risk. I don't think we're talking about we're not going to get insurance at all for golf clubs. We're still reasonably going to be able to cover our buildings, etc. But specifically in our industry, we're seeing higher levels of claims around property, which includes our courses and our clubhouses. And that's where our real challenge is, isn't it, at the moment? So with that, is there some things that golf clubs can do to reduce that risk element that's going to then reduce the level of claims that get put against their policy? Is that where we need to go with clubs to be more proactive?
Yeah, definitely. You know, we try to have conversations with our clients all the time to how we can reduce claim scenarios. And, you know, a lot of people argue insurance is there for the purpose of making claims, and that's not a false statement, but in a soft market, that's a little easier to swallow for an insurer. But with respect to property, and history will suggest that even something as little as or simple as a clubhouse maintenance program, you know, we've learned that 55% of all claims result from storms, and 41% of those claims can be water ingress that can be prevented, if only for something as simple as cleaning and maintaining gutters. So that comes direct from insurers and their frustrations with, you know, had gutters been looked into or cleaned out earlier, they would have avoided such a large loss. And this isn't, you know, a single club on its own. This is a lot of claims reported with property damage following storm have been magnified by the fact that water has overflowed, blocked gutters, and you know, and increased that claim quantum. So, you know, that's one simple thing. A clubhouse maintenance program, recorded maintenance is important, just to make sure that it's diligently followed, and you know, the governance of that club is sort of on top of that.
So that's a pretty small example, like a small example of something that can go wrong at a golf club. Your gutters are blocked and the water's coming in, and there's a problem. We've got a roof leak. We've then got saturated carpet, etc. Like that's something that could easily happen. But you're saying that's a trend across all your golf insurance across the country. That's where we're at here.
Yeah,
we are just maybe particularly bad at some areas of maintenance where our focus might be on our golf courses for maintenance. Perhaps clubs need to sort of start to identify the other risks that exist within their properties.
Yeah, gutters is one of those things that's not exclusive to golf clubs. We've experienced in other industries, even home insurance claims. A lot of us forget to clean our gutters at home. Guilty of that. But yeah, you know, going out to the course, we've got, you know, tree maintenance programs. Can we better introduce programs to manage the risk, being the course, being the product of the golf club? When a storm hits, the amount of tree damage that is either falling on buildings, maintenance sheds, or the course itself that have to be removed as a result of that can get in, you know, the tens of thousands, hundreds of thousands of dollars to as a record on against that club, and I guess against the industry as a storm loss. Now, Maurice touched on, earlier this year we had fires to contend with, we had storms and floods to contend with, and all of these, not to say that all of the claims made during that time could have been avoided, absolutely not. But in some cases, had a tree maintenance program been on the agenda of that golf club, possibly the quantum and the size of those claims could have been reduced. I'm sure Peter's experienced some in his time in insuring the golf industry. Peter, you had some big claims at some of your clubs as a result of course damage?
Course damage, storm damage, through the Melbourne courses especially. February the year before was significant, and most of the sandbelt courses were affected in fairly significant ways.
I might even just help the guys out. So obviously we've got a lot of the golf data available because of the distribution of the product. To Daniel's point, Peter's point, there's a couple of things. The industry is not looking for a way for any insured, let alone golf, to try and mitigate things beyond their control, like cyclone, flood, fire, bushfire, and are things that they're acutely aware of, and they'll look at modelling their own maps as to where they want to write those particular clubs. So if you're far north Queensland golf club, you're going to have issues, as we all know, around the ability to secure appropriate cover for cyclone. What the guys are leading into, and the amount of maintenance claims, maintenance-related claims that we're now starting to see, whether that be felling of trees, that may be large limbs sitting over clubhouses, pro shops, or important parts of the course through a maintenance regime program, should be looked at. As well as that, Matt, to your point, that pure course maintenance, making sure the fairways, the bunkers, the greens are in immaculate condition. But what the relevance here is, and I've seen a couple of questions on the side, so I might just weave in an answer to it. The industry is down to two product providers, Zurich through the AGI product, through Golf Australia's product, and ANZVAR as the main golf respondents to, or golf insurance providers. The market has up to 10 different insurers who may look at a golf course and underwrite it. But the reality is that's short-term underwriting based on volatility or loss record, right? So in pure simple terms, if a QBE was your insurer and you have a poor loss performance that particular year, they may or may not be there at renewal, which means the industry is losing more and more participants. QBE, CGU, Liberty are large brands that have been associated with golf who are now out of golf in a holistic sense. So they will not provide a solution to the golf industry as a broad industry solution. There are two that are looking at it, and the more what we call eroding claims that continue to occur, preventable type losses, leaving equipment out in the open when a storm's coming, not protecting those and putting them in a shed, the market will have a lower tolerance to become a risk transfer option for the industry. So just trying to distinguish between things beyond your control and things within your control, because they're very distinctive in their own right.
I think you touched on something there, Maurice, with the fact that we're talking about industry whole here. So there's underwriters that are now looking at potentially clubs that have not necessarily covered off all the risks that they should have, i.e. leave some equipment outside unsecured or not as well secured as it could have been, that has now damaged the reputation of the whole industry. So therefore, almost as a team, we need to bundle together and just be a bit better at what we do, so that the whole market becomes more attractive to insurers to write as a whole.
Yeah. So to Daniel's point earlier, right? If we keep having 41% of our losses coming from not cleaning your gutters, two things will happen. There'll be an exclusion on the policy, which will say if there was insufficient, that's the harshest element, right? We'll put an exclusion based on a regular maintenance program, scheduled maintenance. So that's the farthest extremity when you get down to one market wanting to write. The one in between is they'll say to you, okay, now for all storm damage claims or inundation or water claims that we're getting out of roof gutters, we're now going to want a $10,000 or $20,000 excess. Now, all the clubs that are adhering to that process, because it's industry-wide, are going to end up with that deductible or excess imposed to them, because the industry can only make a concerted effort on writing the masses of premiums. On average, I'll put it to you this way: New South Wales in February, there would have been 15 clubs that we look after that got smashed by storms. For an insurer to recover those losses, they're going to have to write those clubs for the next 10 years, given the quantum, right? $500,000 losses based on 20, 30 grand premium. What they will then do is you can only push pricing, and we did have a question about cumulative pricing. That's based on quarters. So those average price increases are, in the first quarter, we're seeing single digit, then moving to double digit. Now we're moving to 30% based on quarter rate movements, right? Not cumulative all the way through, because then it would become totally ineffective to risk transfer. So what we're saying now for all of you who are renewing between, just to answer the question that's out there, between now and the end of the year, expect your rating increase can be anywhere between probably 30% subject to no losses. That could be your average pricing movement. And then some could be better based on history and timing, excess that they have in place. But the industry will look to work to a position where they can get the right price point, the right policy structure that will provide a solution and be there for the large loss. So if there is that storm event, they get it, but they don't want the erosion of the premium pool that would deal with those losses, the large losses, to continue to occur. Poor maintenance of gutters. So 20 grand water damage claim happening over 200 clubs is going to cause significant problems. All it's going to be is everybody's going to move very quickly through the pricing curve, and they'll also end up with significant deductibles, which is a pain because that's self-funded loss after. So forget about your premium being 30 grand. You've got a $50,000 deductible. That's a worse position to be in as an industry.
And those deductibles then start to affect those events that are out of your control. So the major storm comes along and there was just nothing you could do about the water coming into the clubhouse, for instance. You then hit with a $20,000 deductible anyway, because of the behaviour of clubs in general for the previous 5-10 years, etc.
Yeah, so markets will imply. So if you're in, again, far north Queensland, there will be a significant deductible whether you're in Gulf or not for cyclone damage, right? Because they know the severity of the cyclone will be up there, so they'll put $50,000, $100,000 type deductibles. For all the clubs that are not exposed to as many of those perils and try and insulate themselves from it, as the industry contracts, their inability to make money out of, assets in the open, poor maintenance, it will start to come through, because most insurers will say, I wrote golf clubs, I had 50 grand of premium, I had a 500 grand weather loss, I've got to write 100 of them before I can make money on it, which is why it comes down to a couple of insurers who try and manage their way through it. So this is not a defensive statement, but the more you go out and commoditize the product by seeking quote unquote, the worse off you're going to be, because you're chasing the curve down. In that first graph that I showed, which was the light blue, the competitive environment, that was getting quote every year. Now, all the market's done is said, there's now no money in it. We're just going to keep whacking it up. I expect that in the next 12 months, and we trade through each of the different areas of risk management, corporate and scheme and affinity business, for the next 12 months, the pricing movement will continue to move because there's no investment return and there's large weather peril type losses that insurers need to fund for. Those APRA stats are not Marsh stats. They're as a shareholder, if you're a shareholder of QBE, Suncorp or IAG, you're losing money.
Yeah, absolutely. So then, Pete and Daniel, I'm assuming you're seeing clubs that have excessive claims, etc. What are some of the good stories? What are some of the clubs that are actually doing the right things, in your opinion, to mitigate some of this avoidable risk that we're saying is bad for our insurance market, and it's just genuinely affecting clubs' expenses?
Yeah, look, I'm glad you spun it to a positive, Matt. There are positives, absolutely. In my own experience, we've had negotiations with insurers, with clubs, both with poor claims history and good claims history, but neither differ when we approach an insurer, one of the insurers that we use, and we say that this club is prepared to adopt or engage in a OH&S, EH&S, WH&S consultant for one of their memberships and demonstrate that they are actively seeking to reduce their risk, to manage their risks. Now, this is the sort of stuff that insurers want to hear. They want to hear that or see that, certain measures are being taken so that the chance of these losses, these eroding losses, which Maurice touched on, can be eliminated so that that club's risk profile is an attractive option for that insurer. We touched on maintenance sheds. Something as simple as installing bollards or removable bollards in front of a maintenance shed. That seems to be behind Storm the second biggest area of property claims at all golf clubs. Maintenance sheds are tucked away in areas that members don't want to see them, which is great.
We hide them so the thieves have access. Yeah,
that's right. Yeah. So just those increasing security on those maintenance sheds is one simple thing that reduces those eroding claims in the second largest ISR peril being theft of machinery. So I think locking expensive items up in caged lockable containers inside those maintenance sheds is even a better measure. So look, if a client came to me with that information, I would be confident of taking that to an insurer and saying, we need to look after this client who's demonstrating a willingness to reduce their risk. And I'm sure there's others that Peter's encountered as well.
Daniel, I think the same thing with those maintenance sheds is malicious damage to the course, which is often done by the chemicals that are contained in the golf club's own maintenance shed. So I think that the whole thing around security covers property, covers public liability, and even leads on to the management liability aspects that we'll talk about later.
Yeah, for sure.
So does that lead then to without providing a definitive list of all the things that can go wrong in a golf club, because that list's pretty long, are we talking about just like a good, solid, active risk management program at a club, no matter how big or small you are? That's what clubs should be having, something that they can manage with their own resources, whether you're a Royal Melbourne or a Timbuktu, having a program in place that helps you as a staff or a committee identify what could go wrong and then doing something within your power to prevent it.
Matt, I think the most success that as a broker we seem to have had with golf clubs is when the relationship with the general manager is such that you're treated as the trusted advisor, and that the general manager has then got the confidence to introduce the broker to the audit and risk committee, so that the broker can have an involvement in the implementation and the policy that's being set by audit and risk in relation to all these issues that we're discussing. Often the broker has access to the finance manager and the CEO, but doesn't often get to audit and risk to actually be able to do those things that can make a difference to the club's risk management program.
Yeah, okay. So a stronger relationship between you guys as brokers, for instance, and those key decision makers at clubs, being audit and risk committees, would absolutely help the cause.
Yeah.
Yeah, okay.
And sometimes all those titles are one person at one small club in a country area. It's like you touched on there, Matt. Not every club has a bottomless funds to spend on consultants to manage risk, and we don't expect that. There are certainly very cost-effective ways to reduce risk without breaking the budget. And look, I think it needs to be, like Peter touched on, your insurance broker should have the experience and qualifications to be able to point you in the direction of, I'm a small club, what can we do to reduce our risk? We're led to believe that if we are demonstrating that we're reducing our risk and our becoming a better risk profile for insurers, that our premiums will be less or capped rather than slugged with big increases each year. And it's not a short-term thing. It would be a long-term win if a club, because obviously those strategies implemented now continue through for several years, and that club isn't experiencing those claims, so they're not, typically they won't be getting as larger increases as other clubs that are.
Yeah. Yeah. Okay. Just, I've got a question around self-insuring some risks, such as landscaping and playing surfaces. Is that a genuine option, guys, in your experience, or is that something that that is probably open to sort of bigger clubs, etc.?
Matt, what's traditionally been rated under a golf insurance premium rating factor is that was generally just thrown in as an extra for golf clubs, where the rating applied to the physical assets of the buildings. Underwriters applied a rate, and just through competition, these bells and whistles were added to an insurance program to give you that landscaping cover and, you know, damage to greens and whatever. I think that we're going to see underwriters restrict that sort of cover, and golf clubs are going to have to start getting ready for areas that they are going to have to self-assume the risk completely themselves. And that
So
landscaping
could happen out of necessity, and that's what you're saying.
exactly.
Yeah, okay, right.
The first, that's just to touch on that. Sorry, Matt.
No, you're almost go
as well. The first signs you'll see is as Peter said, a restriction in cover. So if you've currently got a sublimit that's, call it $500,000, you'll see that come down. The second thing is you'll see the excess level go up, so it'll basically reduce the amount. And if the losses continue and they're unsustainable, because as I said, if you have the average premium 20, 30 odd thousand on the property side, and you start to have $500,000 in average storm type losses, which are impacting playing surfaces, you'll see the market will move away from it because they want to provide the fire and damage cover to plant equipment, building contents type arrangement, and the playing surfaces will become more and more of a challenge.
Yeah,
and the more technical they are, the more difficult they are for even the insurance industry to respond to, because I know of a few that I've been involved in where the greens are quite a challenge for even, the assessor to assess what the value of those are. And as Pete said, most clubs don't even declare the cost of a green, let alone 18, 27, 36 of them as a declared value in there.
Yeah, so up front, you're not paying a premium on it anyhow. Yeah.
And it's normally clubhouse, pro shop, contents, business interruption, that's about the extent of the rateable values in most cases.
There's obviously a strong argument there for golf clubs to suggest that, well, if that's where all the claims are coming, then why shouldn't we pay less for removing that cover? And that is, that was answered what you said there. Look, I think the course is the product. I think there probably are clubs out there that are confident to manage their own, maintenance and following storm events. But, as a collective, it's in my, I've been made aware that some greens are $50,000 each at, even rural country clubs, that's still the same grass. They still require all the same installation and removal. I would hate to see that cover is taken away from the golf industry, because it's, in my opinion, it is the product that we're covering, the golf course. It's for the members, and that's what we've got to make sure we maintain, and we do that through improving our risk profile.
It's a rare club that has a balance sheet strong enough to cover off all of their key playing surfaces should something go drastically wrong. And so 18 greens are lost, for instance. It's a pretty strong club that's got the sort of $1 to $2 million on hand to replace that, and then suffer and power through the loss of revenue that they've got to experience whilst that replacement's happening. So, yeah,
for sure.
Yeah. Guys, I know you want to jump into some of our other insurance areas as well, rather than just property. Let's just flick over to management liability. Is there any sort of major issues in our management liability areas in golf clubs at the moment that clubs can reduce their risk in?
I'll start by just suggesting to our viewers to engage in consultants, experts in certain areas, such as HR consulting firms. There are the claims quantums here come from not the incident itself, but the way that the incident, let's say the dismissal of an employee, is handled. And insurers have found that 75% of claims result from the handling and the management of incidents rather than that incident of unfair dismissal or harassment in the workplace. So I think it's important to get the advice from experts. That should be outside the club, in my opinion, although I'm sure there's plenty of members of clubs that could put their hand up to assist in that respect. That it makes sense to engage in those services early, prevent the bungled handling of a dismissal of an employee or a harassment case, and to draw on that experience from these consultants at the time that it's required.
Daniel, we've seen most of the quantum of claims coming in the management liability area actually relating to defence costs. And as you say, if the precaution is taken at the start, it doesn't lead to the action actually having to be defended. And I think the golf clubs have got to recognise that the management liability isn't a commercial legal expenses cover. It is there for defence costs. And the way to keep the claims down in that area is get the proper advice prior to getting to a situation where the club actually is being litigated against.
And what we're seeing as well, Peter, and I get this from a well-known consultant in the industry, is that volunteer boards, as well as general managers and other executives employed by the clubs, are now putting themselves at risks with decisions that they're making or not making, omissions, errors in the course of governance. That, let's say someone hasn't done their ticket on driving a certain piece of machinery and that leads to a fatality. Those charges can now lead to criminal charges. And I think that's why you outsource this expertise and get the right systems in place to avoid these major issues before they become a catastrophe.
Yeah, if a club's looking at reducing their insurances, this is one policy that I would recommend not be disbanded with. Make sure that management liability is maintained as much as possible.
Absolutely.
Yeah, it sounds like that's a pretty critical one for those that are working in clubs, be it managers or boards. It's pretty important that you're protected in that area. So
yeah, absolutely.
Yeah.
What about some of your covers? Like, there's got a question from an attendee here, just on thoughts on emerging risks like cyber. Is that something that A, clubs can insure against, and B, what is within their power to again reduce that risk? Obviously, we're not just looking to insure everything. That's what we've discussed today. That's probably a bad strategy. So what can we do in clubs to reduce that risk on those policies?
Yeah, look, cyber for me absolutely is the most emerging risk in Australia, and an insurance policy that any club that's collecting and storing data of their members should have. I think the best way to reduce the risk of a cyber attack or a cyber breach for a golf club is to improve your systems, improve your processes. There's a lot of talk about cyber security these days, how that can be better done. Your processes, the amount of clever attempts by hackers for people to open emails and to click on the wrong thing nowadays is becoming a daily occurrence. So just educate your staff, make sure that you're following the protocols that would avoid those cyber losses, those cyber breaches. And once, assuming that you do have a cyber risk, and I think everyone, a cyber breach, and I think everyone will at some stage, is get on top of it straight away, report it to, assuming you have insurance, report it to your insurers straight away, and let them take over the management of, I guess, the fallout from that breach.
Yeah, fair enough. That makes
with the cyber policy, I think that you should make sure you've got a social engineering extension. A lot of the claims that I've seen under the cyber area are for incorrect payments, where systems have been hacked and payments have gone to the wrong account, never ever to be recovered. So that social engineering extension under the cyber policy is a very important one for the club.
Yeah, for sure.
Yeah, brilliant. Guys, we're just running into we're running into the end of our hour, so I'll just sort of put a final call out for some questions from the audience if you've got any, and I'll just try to recap some of the key takeouts from the second part of our discussion this morning. I do have a question around what risks are covered by Golf Australia affiliation fees. I'll answer that one in the follow-up notes. We've got some resources I can point you directly to our website to cover off that specific policy. But just the key takeouts for me today from you guys is treat your insurer as a partner, that they are invested in you as much as we are in them. And if we continue to sort of shop around, we're going to be in a position where we're burning insurers because potentially we've like you said, we give them, say, $30,000 worth of premium this year. We make 50, 60 grand worth of claims, and then we go back to market to help with some more insurers. It's a fair bet that person who's been burnt the year before, they're not coming back to you. I think that's a fair statement there, guys, isn't it? Yeah.
Yep.
Absolutely.
And then the second one for me is identify your manageable risks so that your unmanageable risks on our important property continue to be covered moving forward. I think that's an area where out of probably just complacency from clubs is that, oh, that's insured, that's okay. At the same time, I think we don't tend to leave our cars out on the street unlocked with the keys in the ignition just because it's insured. We tend to put them in our garage or in our driveway anyway because we just don't want it to get stolen. So I think that's a real basic way of spelling out that manageable risk element that clubs can then take away to their facilities and hopefully put some things in place to reduce those manageable risks. So,
Sure.
Just got one question come through. When will we look at how as an industry, how we can come together to balance the power equation and maybe look at bulk buying by clubs that are in some sort of that are accredited in their practices? I think we're basically, from my understanding of the insurance market, I think we're already sort of in that bulk buying, that bulk buying area, given that there is only 2 insurers that will cover us off. Is that potentially a fair statement? And what can we do? I think that probably what we're doing, what we're talking about today, clubs really mitigating that risk is what's going to help in that bulk buying exercise.
Yep. Pretty much, Matt. I think that the only trouble with pooling with the golf clubs is that sharing sums insured. One club performing particularly poorly can then affect the other clubs. Certainly, as an industry, we're grouped in terms of the total premium pool, but it still can come down to the individual club's claims experience for them to probably get a better outcome than pooling with a whole group of of clubs and suffering when there's a major loss to that pool and all the clubs suffering.
Yeah, sure. Maurice, did you want to add anything to that?
I was just similar to what Peter was going to say, but the true form of pooling would be an element of mutuality where you all share, obviously, your commonality and exposure, and then you group an insurer or group of insurers that sit above that, which a lot of local government entities do. However, it's a long-term strategy. When the market shifts, like we're talking about a hard market cycle where pricing is, we're experiencing some quite significant challenges there. But the minute that they turn, you don't form part of a collective buying group or mutual. And to Peter's point, the best performer then goes out and gets a better deal than everybody else and leaves the poor performer out. It's a mature approach that the industry would need to take and collectively buy into, as opposed to chopping in and out of, because you may as well just stay in the market because that's what the market does to you over a period of time. It's called the cyclical market. At a price point when there's an abundance of capital and insurer return, you're going to get competitive pricing. We're at the other end of that cycle at the moment. No investment return, poor losses equals higher price.
It's only good if everyone's committed to the cause.
Yeah,
Correct.
absolutely.
Yeah, okay. Guys, I'll just part with this one then. And it's a great question from our anonymous attendee. As a club, we are contacted by other brokers all the time. if pricing is no longer a driver, what should we be looking out for in a broker? You guys are both stalwarts of the industry, in Pete and Daniel. Mate, what should clubs be looking out for their broker? What should they be looking for in their broker?
Yeah, I guess we'll be giving away some trade secrets here, Peter.
Yeah.
Oh, look, I think it's about partnering with your broker. You know, for Golf Business Australia in particular, we have a set of risk reduction strategies. We've engaged in partnerships with several organisations that we introduce our members to, our clubs to, and assuming that they adopt some or all of those measures, we feel we have a very strong argument to take to our insurers to say, well, this club is doing what's been asked of them. Let's look at ways to offer them more favourable terms. And that's, look, everyone sort of is categorised by the size of the club and the sub-limits that Maurice mentioned earlier. You're a small club or a mid-sized club or a large club. But I think business interruption insurance, which I know Peter wanted to have a chat about, you can look at whether or not you have the right cover there, engage in independent review of that particular cover. Some people, most people are either incorrectly insured or in some cases over-insured, depending on how that policy is set up. So you could, look to do that. OH&S consultants, in my opinion, are worth their weight in gold. They sort of demonstrate how they are reducing risk at golf clubs and why an insurer would support a club that is actively involved in a membership there. And look, I think we draw on our experiences like any other person. We've fought and won battles for clients, and I think at the end of the day, both Peter and I could probably, assist a club's understanding and improve one's risk profile to provide better terms at the end of the day. Many brokers will call, that's right, everyone wants to insure their club that they're a member of. I'm a member of a club, and it's one of those things that I prefer not to be involved with at that club, whilst I'm happy to give it some advice to that club. Sometimes it's better to outsource your insurance to someone that might have the expertise that others don't. So, Peter, thoughts?
Yeah, I'm on the same page as you there, Daniel, in respect of the services that a specialised broker can have, especially for the club to get the best value for their insurance spend and not be doing a misspend on insurance and not having covers that aren't going to respond in the event of certain claim situations occurring. I'm probably against you a little bit on the club situation. I love my clubs and I love being involved with them in the insurance of it. And I know it might be better to go to the club and not have to worry about being their broker, but it just makes me feel more a part of what I'm doing. But that's just for me.
Yeah, and just to add to that, I mean, from my point of view, previously being in clubs, I think having a good relationship with your broker was the most important thing for me. Like having a broker who understood my business and understood the risks that we had, that was the important thing for me, because we could have a really good discussion and they could then take that knowledge to the insurer to make sure we were covered where we needed to be, etc. That was the key takeaway there, guys. We've expired our hour, so without any further ado, I'd like to thank you all for your time. Maurice, I know you're a busy man. Thanks for taking the time out of your day to join us today, and thank you for your insight on the global market, mate. Much appreciated.
No problem. Thank you.
And Daniel and Pete, you guys are all equally as busy as well, but thank you guys for coming along today and giving us an insight from an independent broker perspective about how what Maurice talked about earlier really does affect our clubs. So thanks, guys, for your time today as well.
You're welcome.
Pleasure,
Thanks for having us.
Thank you.
Thanks, and to all the participants, I'll flick out the show notes later on today once we've got the recording up on YouTube, and we'll have a few other. There's been a couple of questions along the way about some other insurance products. I'll make sure I include all the details in them around there. And thanks for joining us, and we'll see you next time. Thanks, guys. Ta.